next guest, Janney Montgomery Scott analyst David Strasser, says that Liberty Media's offer of $17 a share is inadequate. David joins us from Boston. He currently has a buy rating on Barnes & Noble. David, great to have you with us. Why is it inadequate? Where should it be?
The stock our price target was $20, and we believed it could actually go higher than that. I think the value around the e-reader is enormous, and around the Nook, the opportunities there. If that business gets to $5 or $6 billion industry, these guys currently have about a 30% market share, and the margins here are better than they are at the store level.
Actually, break that out for me. How much is the Nook actually valued at right now? How much is that of the $20 price target?
It would probably be more than $20. I mean, you could argue you could get $3 to $4 of earnings out of the e-reader part of the business. That would be a $25, $30 business. And I actually think when I initiated a couple of weeks ago with a buy rating, a lot of people laughed at me saying this is the end of the bookstore business. I actually disagree with that too. I think the book business is going to last a lot longer than people think. It'll go in decline, but they also have a couple of years now up against Borders going out of business and their bankruptcy to actually help the transition.
Hey, David, it's Dominic here. One of the things, you cited a number of reasons why you think Barnes & Noble shares are a buy with a target of $20, one of which is the college bookstore business. You're saying that has some great earnings power and visibility, something that can help sustain the rest of the businesses if this is going forward here. What else is driving it besides just this earnings visibility that you're talking about here?
Well, if you look at EBITDA around the college bookstore business, it's just over $100 million, $120 million of EBITDA. And what that's important about is it just gives you some consistent cash flow as they go through this transition. It's also like it's the same. I almost put it in the same bucket as the Borders going out of business or the Borders bankruptcy. It gives you some cash flow as they make this transition, where the ultimate value is in this e-reader business.
Right, and Malone, as I was talking to Dominic about this, Malone also said, look, don't count out the physical part of Barnes & Noble. It still has a lot of value. He likes walking into bookstores. He's walked into them, for decades. What could he possibly do to improve the Barnes & Noble, the physical bookstores?
Well, first of all, not the whole world's going to go to e-readers. People are still going to buy books. Remember, the only place you really get the big backlog is at Barnes. After Borders goes out, the big backlog you can still get is really only at a Barnes & Noble or local booksellers like a McNally Robinson or something like that. They have added games, children's games like Learning Center games and stuff like that is one thing. They still the cafes, the Starbucks cafes still do really well. I think the death of the bookstore has probably been greatly exaggerated. I agree with him there. I also think that in some ways he's almost revaluing brick and click, and that this argument that all retailers are going out of business because of Amazon or the internet just makes this type of bid makes it ludicrous.
But how does he cut the costs, though? The costs on that physical side, on the bookstores?
Yeah, I think one area is one of the things that Barnes & Noble did over the years. They went after absolute A locations. They went after some high-end. They built some very expensive stores. There's one in Baltimore, for example. The one on the Upper West Side of Manhattan, which they've since closed, lost more money than maybe any other retailer, despite how sales did, just because the rents were astronomical. So there's definitely opportunity out there to bring down that cost structure just by not growing or opening these super duper A locations locations.
David, we got to bring it back to the personalities. Right now, we got Ron Burkle, a guy who's been involved in Barnes & Noble for a while, kind of almost battling it out with John Malone at Liberty Media here. When it comes down to Burkle, how much of a disruptive force can Ron Burkle be in this potential acquisition? Do we see a higher bid from somebody else come down the line here?
I can't tell you I know exactly what he's thinking, but buying 600,000 shares at $18.50, I don't think his goal is to sell them at 17 again, right? I think he plans on being a disruptive force here. We don't know what Len Riggio, who owns over 30% of the company, is thinking as it relates to this deal as well. And Len has had a great history of deal making, and generally being on Len's side, you make money doing the deals. If you're against him, not as well. There's a lot of personalities here and some very smart ones. Once again, I think highlighting how much value there is here. There's some really smart people fighting over this asset.
Two shrewd deal makers for sure. David, thank you so much for joining us. David Strasser of Janney Montgomery Scott.